Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
What's up, you guys? Welcome to another exciting episode of the Bigger Cash Flow podcast. Today, I'm very excited to bring Ramsey to the show. Ramsey is a seasoned real estate finance professional currently working as a commercial mortgage banker at CoreVest Finance. Prior to working at CoreVest, he has also worked at a real estate private equity firm. In addition to having a career in real estate, he himself is an active real estate investor with a growing rental portfolio. So, Ramsey, welcome to the show, and I'm excited to talk more about commercial financing at CoreVest.
Yeah, thanks for having me, Bo. Definitely appreciate the invitation. Hopefully we can go over, all your questions and give people a pretty high-level overview what we offer and how we can help.
Yeah, definitely. So my listeners may already know I mentioned CoreVest a couple of times on my podcast previously. They're actually the go-to lender that I have after I tapped out on my Fannie Mae mortgages. So once I used up those 10 Fannie Mae slots, I went ahead and bundled my rentals into a CoreVest portfolio loan. So I have a couple different products with them. So I definitely want to introduce CoreVest to my listeners. So why don't we dive right in? And Ramsey, if you can give our listeners a little background about yourself, and then we can dive into the CoreVest products.
Sure. Yeah, of course. Well, I've been around real estate my whole life personally. I mean, my parents were pretty active. My mom's a realtor, and my parents, they would flip homes. They accumulated a rental portfolio. So ever since I was, just able to speak, it's been something that I've been around. A lot of conversations. I was managing properties when I was like 15 years old, kind of going to job sites and replacing garbage disposals and different things that went wrong in property. So something that I've definitely been around for a while. And as I've, grown professionally, it's really all I've worked in, real estate finance specifically, both in the private equity side of things and now the debt side of things. So definitely a passion there. I mean, I own a few properties. Mine are located in Pittsburgh, Pennsylvania specifically, and, high yields out there, which is, what I target. So when it comes to CoreVest, my favorite part of my job is the fact that I get to talk to real estate professionals, all over the country. Most of them have done relatively well for themselves. So always, learning and I think uncovering more tidbits of information to kind of continue, I would say, sharpening the pencil and growing, having a lot of tools available. So,
yeah, that's awesome. It must be really nice just being so close, to real estate in terms of your W-2 job as well. So you have a close pulse on the market, understanding what's really going on. I know
100%.
There's a couple different products that CoreVest offers, but for the purposes of this conversation, I do want to frame it around the residential rental portfolio program that you guys have. So if you can give our listeners a high-level overview about what that is and what kind of services you guys offer from CoreVest.
Sure. Yeah, that's our flagship product. So, I mean, we probably, from a business standpoint, probably about, let's say 2/3 of, money that we actually deploy is through that portfolio loan product. So it's really a pretty versatile product. I mean, at the end of the day, I think its best use case is, just like the loan I think that you've closed with us historically, is when people get tapped out of the conventional financing, we offer a great way to clear your deck per se. So what we'd be able to do is, if you were to, let's say, accumulate, 10 rentals through conventional financing. Conventional generally means agency debt, Fannie Mae, Freddie Mac. At some point, you'll get tapped out. I mean, whether it be you hit the 10 allowable loans that Fannie Mae, Freddie Mac lets you have, or you get tapped out through debt to income ratio that they'll be monitoring quite closely as well. So the portfolio loan lets you really take a commercial loan. It's a very similar loan structure to what you'd find on, let's say, a 45-unit multifamily property. The difference, it will be on these detached single-family homes, condos, townhomes, as well as small multifamilies. So what we'd be able to do is do one global refinance, pay off all your existing Fannie Mae, Freddie Mac debt, and put you into what I think most people would consider pretty affordable long-term commercial debt, where at this point you now have access to use your Fannie Mae, Freddie Mac loans once more, get yourself fixed into a long-term fixed rate term loan with CoreVest, and at that point, it's kind of a rinse and repeat type cycle where you can go and kind of continue going through the portfolio through that avenue.
Yeah. And this couldn't have been more timely because last week I talked on my podcast about scaling and managing your rental portfolio. And I have really seldom met an investor who buys just one or two and just stops, especially if you're an out-of-state investor going for cash flow. Once you get a taste of it, you really want to grow this thing. But a lot of us gets tapped out once we hit those 10 Fannie Mae loans. So this is just a great way to bundle it all together under one blanket loan and be able to really clear the deck, like Ramsey said. So can you kind of explain to our listeners a little bit more about the differentiations between the commercial lending side versus the conventional side?
Of course. Yeah. So, I mean, at the end of the day, all banks, what they're really trying to do is figure out your ability to repay your loan. So from, in conventional loans, what they'll be doing is they'll be asking for your tax returns. They're going to look at how much money you've claimed that your income. They're going to be running a calculation based off of all your outstanding mortgages for real estate, your car payments, and they're going to be calculating your debt to income ratio. That's really kind of the by far in the conventional space the most important metric. They're going to be looking pretty closely at that. Historically, it's been 43%. That's what they're. Once you hit that, you're tapped out. So all they really want to see is the ability for your income that you bring in through your job to be able to pay your monthly mortgage payments. Now, on the commercial side of things, we actually have a completely different metric we're looking at. We're looking at DSCR, so that's your debt service coverage ratio. So that is more so, instead of looking at the individual's ability to repay their mortgage or repay their loan, they will specifically be looking at the property's ability to pay its mortgage. So we specifically underwrite to a 1.2 debt service cover ratio. Every company will have slightly different standards, but the simplest way to understand it is we want, let's say if we're looking at a multifamily property, a 10-unit property, for example, we want to make sure that gross income that's brought in minus its expenses will be able to cover its monthly mortgage payment at a 1.2 ratio. So if you're bringing in net, let's say $12,000 monthly, they would want that the maximum monthly payment to be $10,000 a month. So that means you'll always, the property, just by operating it properly, will be able to cover its monthly mortgage. So due to that specific difference, the fact that we're underwriting based off of cash flow rather than your personal debt to income ratio, this lets you be able to take on significantly more debt, which helps you, as Bo has mentioned, scale your business.
Yeah, especially for some people who may not be W-2 workers, maybe they're 1099, or for whatever reason, their DTI ratio is not favorable to them. Like maybe they live in California and they own a property here, then it significantly takes up a lot of DTI space. So I think for those very
100%.
reasons, portfolio loans are very appealing. So also, I guess in terms of like credit score, liquidity, net worth, those are some questions that I personally had when I was first looking into this program. Can you speak a little bit about those as well?
Yeah, so what's a little unique to our lending, I would say, program compared to like more conventional is in the conventional space, your credit score is such a huge determinant of your actual interest rate. For us, credit score is very much a pass or fail. So historically, if you're over a 650, you pass, that's good, you qualify. If you're below, if there's, let's say you're below maybe a 6 or above a 620 and there's a good story, we can maybe get, our underwriting team comfortable, but it's generally, that 650 is kind of that threshold. If you're above it, pass. If you're below it, fail. So it's pretty straightforward on that front. And my apologies, Bo. I think that was multiple parts of that question. What else was asked there?
Yeah, no worries. I lumped in a few there. So credit score,
Yeah,
as well as liquidity and net worth.
perfect. Yeah, so also pretty straightforward. So two things we'll be looking for from a both liquidity and net worth perspective. So from a liquidity perspective, we want to see 5% of the loan amount in liquid assets. So we would be able to count anything that can be turned into cash within 30 days as liquid. So that'd be your stocks, bonds, 401k, savings account, anything along those lines would be able to count towards that 5%. So if you're looking at, for let's say $1 million, portfolio loan, we would want to see $50,000 in liquidity. Okay. Now, from a net worth perspective, we'd be looking for 25% of your net worth of loan amount. So, simplest way, let's say it's $1 million portfolio loan. We want to see that you have a net worth of $250,000, excluding the properties we'll be financing. Now, net worth would be, total assets minus liabilities.
Got it. Okay. So those are some initial bars that a potential borrower must fill out. And it's pretty basic. I think whether you go to CoreVest or any other commercial banker, they're going to ask you for your personal financial statement, or you have to list out your assets and liabilities. So it seems to be in line with some of the other bank requirements as well. So a lot of my listeners
I wouldn't say we're unique there. My apologies.
Yeah.
Go ahead.
No worries at all. Yeah, so a lot of my listeners might be listening to this and be like, this is awesome. Why have I never heard of this? Because I personally was very surprised. I thought commercial financing, you naturally think, okay, 5 or more units. It needs to be some sort of like business commercial building or multifamily apartments. But I was very surprised to find out that you guys lend on residential properties and small multifamilies. So with that said, maybe we can kind of play through a scenario. If I'm a borrower, I have properties in the Midwest, like Indianapolis, Kansas City, where I invest in. I go to you guys and I apply. What does that process kind of look like? Can you kind of walk me through a application and just the approval process?
Sure. Yeah. So one thing that with our type of debt as well, I think most commercial lenders is, when you are looking to underwrite based off of cash flow, the first thing that people are going to ask for, whether it be me or, one of our competitors, is they're going to understand, the properties that we'll be financing. What does their rent roll look like? We're going to be asking, we call it a data tape. So we'll want a data tape completed, which means, please outline the properties that we'll be looking at, their address, so we can do a little bit of research on that front. But we also want to understand what is their monthly rent that is being brought in, what are their annual taxes, annual insurance costs, and what is the current value of the property. With this information, we'll be able to go ahead and run a proper cash flow model and actually be able to get you some feedback pretty quickly as to this is what we'd be able to offer. This is what the cash flow that your properties are bringing in would be able to support. At that point, we'll usually get you a few different quotes. We'll make sure to come up with something that you will feel comfortable with, and at that point, we'll have you fill out an application. The application really asks 3 basic things, which Bo's kind of touched on. We're going to ask for what's your current liquidity, what's your net worth, and then your FICO score. Those are kind of the 3 things from a borrower's perspective that we'll be looking at. We take you at face value, at least at the offset. We will be during the course of the underwrite, as we move throughout the loan, actually kind of double checking, looking for bank statements, personal financial statements, etc. But it's a pretty straightforward process. Once we actually get a quote in front of you, we get you a term sheet. If everything looks good, we'll walk you through it, make sure you understand, what you're getting yourself into and the product. And at that point, we put your deal into underwriting. We are by far the largest private portfolio lenders. We do quite a few of these transactions, and we've kind of got it down to a science at this point.
Yeah, definitely. To say quite a few of these deals would definitely be an understatement. I think you guys crossed $6 billion or some ridiculous number, right?
Yeah, we were incepted in 2014, kind of in the wake of the recession, realizing that a lot of people that were looking to grow these single family or residential portfolios didn't really have a lot of good financing options. So I would say, pre-COVID, we were, I think we did roughly 1.5 billion that calendar year. So, I mean, we've been very active. It's been I mean, you probably can highlight on this as well, Bo, but I mean, the single family rental portfolio space, I think, is really growing. I think a lot of, even from a Wall Street perspective, you're seeing a lot of players get involved, and it's really becoming a more solidified asset class.
Yeah, definitely. Yeah, Wall Street is definitely coming into these neighborhoods. So, once you apply, you get the term sheet. And from my experience as well, CoreVest, just a disclaimer, is not a sponsor of this podcast. I'm not affiliated with them, but I have to say my experience has just been so good with them that I really wanted Ramsey on the show. Being new to commercial financing, it was pretty smooth from day one. There's like a kickoff call with everybody involved. They tell me what the requirements are, what the documents they request from me. I would say actually the documentation isn't as crazy as a a Fannie Mae loan. Sometimes, some of the documentation that they look at, the underwriters, they look at your bank transaction. What was this line item on May 14th of 2019? It gets pretty crazy. As long as you use a system like QuickBooks or Stessa, you should be able to pull your rent rolls as well as your income statement, balance sheet, things like that pretty easily. That's what they require. So let's just say we go into the underwriting process. What are some of the things that we might be able to expect, in terms of appraisal, inspections, title, things like that? Is it pretty similar to a regular transaction?
Yeah, I mean, when you really think of it, any mortgage that's going to be recorded will require title to be run. So you can really assume for any loan you'll be getting, title will be involved. For us, we'll be requiring appraisals. Also, I think pretty standard in the industry. I think the only thing that's kind of unique to us is the fact that we're not an agency loan. So I mean, we have an underwriting team that underwrites based off of really securitization standards. So at the end of the day, we take these loans and we securitize them, put them in as bonds into the market. So I think to a certain extent, there are certain documentation we will need to make sure to abide by those rules. But I would say, if you are organized and you have QuickBooks, or I think you mentioned another system I actually wasn't familiar with, but a lot of people use QuickBooks. A lot of it's pretty straightforward documentation. So it's different than what we'll be asking for from like a Fannie Mae perspective. So I'm not, was that a sufficient answer? I mean, were you looking for a specific list of documents?
No, not at all. So yeah, I think you're exactly right. For me, at least, it was a very similar process. Title will do their thing. I was actually able to leverage some of the title insurance that I used when I first purchased the property, and I sent it to title, and it's just doing like 9 deals at the same time. So they kick off when I had 9 properties that I refinanced, just to clarify.
Certainly.
So I had 9 appraisals sent out, and then I had 9 warranty deeds and title work for those properties. Legal gets involved, so that was pretty cool. Previously I haven't owned these properties in LLCs. But CoreVest does require an SPE, or a special purpose entity. So why don't you talk to our listeners a little bit about that and what that means? Because a lot of borrowers actually want to move properties into LLCs, but they historically cannot with Fannie Mae loans. So that is a big difference. Can you talk to our listeners about that?
That's awesome. That is something people really like about the loan product. So we require all loans we give to be to newly formed Delaware LLCs. So these LLCs can be owned by you in your personal capacity or an existing entity that you're operating through. So if you're operating through like an LP or like a S Corp or an LLC, you can all be, underneath that pre-existing umbrella. So a lot of investors, I think, especially when you start, you'll be getting those conventional loans. They're probably a great place to start because I do think they're pretty easy initially, but they are all, in your personal name, which comes with increased liability. So one thing that I think a lot of people enjoy is once you kind of accumulate those, 10 or, Fannie Mae, Freddie Mac loans, or you've hit your DTI cap and you're looking to go ahead and, clear your book, you can come to us and we would be able to put those into an LLC, which would now get those out of your personal name, which would decrease your liability. So I do think that is definitely an added benefit.
Yeah, definitely. And when you say, off of your books, just to clarify, these will not show up on your personal credit report. Is that correct?
So that's a bit of a loaded question, because it really comes down to recourse or non-recourse, which is an option that we actually have. So as a private lender, we're able to offer non-recourse debt, which is quite unique to us, something that I think, to give a little bit of context, non-recourse means that you wouldn't have to put a personal guarantee in place. So every loan that you'd be getting from a credit union or a personal or a conventional loan will be a recourse loan, which means in a worst case default situation, they'd be able to go after both the properties as well as your personal assets to recover their losses. With a non-recourse loan, it's the properties stand by themselves, which means in a worst case default situation, only the properties would be held as collateral. Now, when you go to run a credit report, any loan that is in the name of an LLC generally will not show up on a credit report, but there will be a section when you're filling out to do a credit check asking, are there any other liabilities that we should be aware of? Something along those lines. And by law, you're supposed to disclose, even if the loan is an LLC, that if it's a recourse loan, you would have to go ahead and highlight, yes, I do have additional liabilities because I'm the guarantor of a loan, even though it is taken in the name of LLC. Now, one thing, if you do a non-recourse loan, you wouldn't have to even go ahead and disclose that. So that's completely off of your credit report.
Awesome. No, that's actually was on my list. So that was a great segue into the recourse, non-recourse discussion, because these are all things that I learned as I went. I had no idea you can get 30-year amortization on, commercial financing. I didn't even know commercial financing existed on residential properties. And come to find out, you can also get non-recourse. All three of those things I got on my 2 portfolio loans when I first started with CoreVest. So just wanted to educate our
I'm going to start
listeners.
Introducing you to all my clients. You probably want a great external salesman. I don't even need to talk anymore.
Yeah, I just love the product so much. We'll probably get into it a little bit later with COVID's impact on the lending side, but I just can't wait for the moratorium to be lifted. Because as of this recording, a lot of the commercial financing has dried up. It's not just CoreVest. A lot of banks in Indianapolis where I've called, or other competitors of CoreVest, they're just at a wait and see right now with COVID. So I just really can't wait.
Yeah, I could touch on that a little bit. So one thing that has happened, since COVID is the commercial real estate space has really been turned on its side a little bit, specifically what we consider like the CMBS market. Really all CMBS lenders are companies that will be originating mortgages and then taking those mortgages, putting them into securitizations and selling them as bonds. So for a while, the bond market was just flooded with really cheap government debt. The bond market to a certain extent was turned on its side. So with that was a short-term issue that I think kind of at least had lenders kind of holding off for a little bit. They wanted to see that the market stabilized a little bit. On top of that, there is a lot of people were a little worried with where rent collection will be. And I think you've personally I don't know if you disclosed this, but you said your collection has been pretty strong, and I think that's something we've been seeing a lot. Not just locally, but kind of across the country. So I know us personally, we should be up and running pretty shortly. Everything I've heard from our executive team has been positive recently. But yeah, the market was definitely turned on its side for a little while.
Yeah, no, glad to hear that. Thanks for sharing that, by the way. That's really interesting to kind of also understand, how CoreVest operates as a business, and, you guys are kind of securitizing these as bonds. So I feel like, to me, when I hear the word bonds, it's more of a safer asset. So it's nice to hear that these are being underwritten to that standard as single family homes. So that's nice to hear.
What's safer than real estate backed bonds? I think historically they've been great places to put your money. maybe discrediting 2008, but
Right.
yeah, I mean, our bonds, majority of them are AAA rated. So I think we've done pretty well thus far. Fingers crossed.
Yeah, no, definitely. If you're looking for insurance coverage for your rental properties, the company that I trust is Ross Diversified Insurance Services, a national insurance agency that has been providing insurance coverage for real estate investors for over 30 years. Whether it's a rental or a fix and flip, Ross provides you coverage through A-rated insurance carriers to provide you with competitive rates, as one size does not fit all. Check out biggercashflow.com/RDIS to get your free quote today. When you're purchasing your first property or the next, you want to work with an experienced lender who's got your best interest in mind. Sean Huss at Chemical Bank has been a professional in the mortgage industry for over 25 years and has helped hundreds of investors like you and me grow their rental portfolio. With expertise in areas such as real estate sales, title and escrow, and the mortgage closing process, Sean is able to provide comprehensive counsel to guide you throughout this often complicated process. Check out biggercashflow.com/chemicalbank to get pre-qualified for free when you mention the Bigger Cash Flow podcast. So we kind of talked about, our personal requirements, whether it be credit score, liquidity, net worth. We mentioned LLCs and non-recourse just little bit on the liability and personal guarantee side. What about the properties themselves? Is there like a loan minimum that you guys have, as well as like a loan to value ratio? If I already have Fannie debt on it and you guys are paying those off, what's that look like from an ARV perspective?
Yeah. So, a few questions there, but starting off, I mean, the properties that will be able to qualify will be single family homes, condos, townhomes, multifamily assets. We'll even do some mixed use if they're predominantly residential. Now, with that said, there are certain minimums and maximums. So we're not really looking for the really low end, valued assets. We're not really trying to chase that bottom segment of the market. So anything in our eyes that's below $50,000 per single family home would not qualify. And then for condos and units in a multifamily, it would be below $40,000 per unit would be assets that we wouldn't finance. Now, from a max perspective, generally this is specifically on the single family side of things. We're not really targeting like the luxury market either. Plus, I mean, I'm sure if you run the numbers, you'll see that luxury properties tend not to cash flow as well, at least in a traditional, 1 year standardized lease type model. So generally up to $1 million is about as high as we'll go on a single family home on that side of things as well. And of course, exceptions can be made to both sides, but generally those are our guidelines on, the values on a per property basis. I think you also mentioned LTV. We'd be able to go to a maximum 75% LTV as long as the cash flow supports that leverage.
Okay. And 75%, if I own 10 homes, $100K a pop, so $1 million ARV, am I eligible to get a cash out refinance if I own them free and clear?
Yeah. So, I mean, I would say majority of the loans we do actually result in a cash out refinance. So there isn't really too much of a restriction on that front. I mean, we'll be looking at the current appraised value. So if the value of your 10 properties, collectively comes in at $1 million and the properties support from a cash flow perspective alone of $750,000, then we should be able to do that all day.
Awesome. Yeah. So I think that's important to note. You have your data tape, and just in my experience, you have your projected numbers of what you think it will cash flow and what you think the values are, and along with that, how much debt you have on the properties. But as you further progress in your underwriting process with CoreVest, my experience is that number can slightly adjust up or down, right? Based on the ARV or the final numbers that it settles on. Is that correct?
Yes, so 100%. So, I mean, the term sheet you'll be getting will be based off of the numbers that you have provided to us on your data tape. So one of the biggest things is, your borrower opinion of value based off of where appraisals will come in. I mean, I'll be honest, I've seen, I don't even know how many tell you, dozens, hundreds of portfolio loans at this point. And believe it or not, people can be a little aggressive with, their valuations. I'd say maybe 65, 2/3 of the time, people will overvalue their properties a little bit. But with that said, I mean, like I said, that the term sheet is based off of projections, and as we actually get the values that came in from the third party appraisers, and we get the actuals with taxes, insurance, and rents. We can then go ahead and give you a your actuals at closer to your closing date. Generally, it's within, I would say, 5%. I mean, we're not seeing huge swings here by any means, but yeah, I think as we get actual numbers, we do get a more dialed in figure as to actually what your loan will be.
Awesome. And in terms of terms and rates and amortization, this is also, I've seen, ranges depending on the banks that you talk to. Can you kind of talk to us about, I have my personal experience. Can you talk to us about what you most recently saw pre-COVID? What kind of options there were?
Yeah, so I mean, we offer a 5, 7, or 10-year term loan amortized over 30 years. So it's a fixed rate for that 5, 7, or 10 years. It's very much a standard, let's say, loan structure in the commercial space. So one thing that's a little unique to us as a private portfolio lender, as compared to if you go like a local bank, is we actually get to amortize over 30 years, which is nice because two things. One, it keeps your monthly payments low. On top of that, it lets you qualify for a higher loan amount based off of how the DSCR calculation works. Now, most local banks, or let's say credit unions that are doing portfolio financing, will usually be a 20 or 25-year amortization. So that is definitely something that is nice. Investors, that we work with tend to enjoy that element, being able to keep that lower monthly cash flow or lower monthly payment, which increases their cash flow. Now, something else to note is we'll be able to go, I think you mentioned this, up to 75% loan to value. Interest rates pre-COVID were in the high 4s, low 5s. I'm interested to kind of see where post-COVID rates will shake out. I think there'll be a little bit of upwards pressure, but if you were to ask me, I think as time progresses, the market continues to stabilize, I think we'll kind of tread back towards where we were. So yeah, I mean, at the end of the day, our ideal client, it's an individual who, has been investing in real estate for the past 5 years. They've, accumulated 10 rental properties. They, at this point, have been able to, the properties have appreciated. They have some equity into the properties. We'd be able to come do a refinance on that whole, 10 single family homes, cash them out up to 75% of the current appraised value, usually put some cash in their pocket because, they've, rode the market. Their properties have appreciated since then. We'll get them fixed into a 10-year term over 30 years at a 4.75, 5% interest rate. And at this point, they've paid off their Fannie Mae, Freddie Mac loans, and they can go and use that money that they've just put in their pocket from their cash out refinance to go buy more properties. So we kind of, that's really the quintessential business model. I mean, I've helped dozens of, clients of mine do this exact thing. So if you kind of, investing in real estate and looking to scale, I think, the portfolio loan really is a strong product and tool.
Exactly. Yeah. I almost think of it like Burr on steroids. Like, if you guys are familiar with the buy, rehab, rent, refinance, repeat strategy, where you're just creating a lot of value and equity by doing the work yourself instead of buying turnkey or at market value. Now, you have to historically do it one by one, right? You're getting a conventional financing with Fannie Mae. But imagine you get a CoreVest bridge loan and you get 10 rental properties on their line of credit. And then once you're ready, you package those up and get a portfolio loan. Boom, you're almost 10xing it. Grant Cardone will be smiling at that rate. You're almost doing Burr on steroids.
That's a great way to put it. Burr on steroids is, I would say, generally how our line of credit and portfolio loan product complement one another. I think a lot of people get started, like I said, with the conventional, slowly acquiring the properties. But once you really want to pick up the pace and really, scale the operation, get a few properties what we could do is get you set up with our line of credit product. Line of credit product is really catered for people looking to acquire multiple properties quickly in a short period of time. It's a one-time underwrite. We'll be asking for some documents. It usually takes 2 or 3 weeks to get you set up. At that point, as long as financials are strong, you have good experience, and you have a good FICO score, we can get you set up with a few $1 million line of credit. At this point, you can put multiple offers in the marketplace. As soon as something is accepted, we'd be able to fund within 5 to 10 business days. So it's really streamlined access to capital once it's open. At this point, you get inside the property, you usually do light rehab or more, let's say, if you need to go into larger construction projects, we'd be able to facilitate that as well. And then ultimately you get renters in place and then refinance with a portfolio loan. And it's just a rinse and repeat. We have people who have done this 5, 10 times through, just have a whole dozen properties in their name or hundreds. So it really depends on I think motivation and being able to, like as Bo said, create that value add. As long as you can get into a property below current market price and do some light rehab and get it rented, it's just at that point a matter of turning and burning. It's a proven model.
Yeah, definitely. And a lot of people have asked me through the podcast, Bo, how have you been able to scale up to 61 units? And there I just gave you all my secrets. I have 2 lines of credits with CoreVest and 2 portfolios trying to go for the 3rd and 4th. It's just a rinse and repeat for me once you get the system down. Now, obviously, if you don't know what you're doing, if you go too fast, too quickly, then you might crash and burn. But if you're a seasoned 100%. Investor and you have systems in place, this is going to be that gasoline to an already burning flame, in my opinion. So just good tools. I love
that,
to have.
I might start using that. The gasoline.
Yeah. And yeah, quick shout out to Cecilia and Jessica from the CoreVest side. They've been just fantastic on helping me with the line of credit as well as the construction management side. And this is what I really like about working with a professional company, basically, that has their infrastructure in place. It's not just your mom and pop hard money lender. They definitely do their job as well, but just having a strong team in place to help you with the acquisition as well as the refinance portion, so that you guys can focus on doing what you do best, which is finding discounted deals, putting tenants in place and just managing your portfolio. You don't have to worry about all this other stuff.
I'm going to make sure to let Cecilia and Jessica know that they got a shout out. I'm sure they'll appreciate that. One thing to note on the line of credit is we'll be able to both finance the acquisition and the rehab. So there is a construction financing element to that. And whenever you get you finish your underwrite, you get your proof of funds letter, you'll get assigned usually 2 points of contact to reach out to one, coordinate the acquisitions and the rehab component. With that said, I don't think I went into as much detail as I'd like. What's also really helpful about the line of credit is it's generally a high leverage product. So with that, whenever you talk about high leverage, you definitely, there's an element of knowing what you're doing, not getting a little over leveraged, but generally we can finance 90% of your total costs on that product. So definitely some potential to get a lot of properties kind of under the umbrella. And as long as you're able to increase the value when you go and ultimately refinance, ideally with the portfolio loan at 75% LTV, you should be able to pay off your line of credit debt with your portfolio loan debt.
Yeah. And just to put it in perspective, I think Ramsey did a wonderful job describing what the bridge line is there to do. But just to compare it to some of the hard money lender terms that I've been quoted before, right now on my CoreVest line of credit, and it might differ from people to people, but I'm paying 1.5 during acquisitions, and on the line it's about 8.25 or 8.5% interest only. A lot of the hard money lenders have been asking me for 2 points and 10%. And that's not even that bad. Some people ask for, 2 points and 12% or something like that. So CoreVest has definitely been cheaper even when comparing it to other hard money lenders. And the fact that I'm going to the same person to get multiple properties in a big line of credit, that's just been really streamlining a lot of my operations, just to compare.
Yeah,
What are your thoughts on that?
The line of credit, the line of credit product, it varies in price. I mean, people who are doing a lot of business can get really, pretty competitive terms, into the sevens, and, as low as a point. And then, we can, for, let's say, the people who are just getting started, have a couple projects under their belt, they'll probably be closer to somewhere in the nines, So, I mean, it is kind of a sliding scale, and very much based off of, we'll be looking at your experience, your financials, and et cetera. But I would say generally we're definitely cheaper than hard money in most markets. On top of that, I think even if there is, let's say, one lender that'll be able to give you a quarter point lower here or there, I think what people don't really put into, I think, enough value is the fact that you're lining up your financing, you're completing your underwrite. It's a very proactive approach to getting, if you're really looking to acquire a few properties in a short period of time. I think investors, usually have so many things on their mind, especially if they're doing a few projects, they're juggling, contractors and realtors they're working with, et cetera. This kind of, to a certain extent, you get your financing lined up. It's just at this point, you're looking for good deals. As soon as you find a good deal, you can put an offer in place, and then you can get, you can put a 2-week closing time, because we can go ahead and get that done within 10 business days. So it really, I think, is a proactive approach to financing, rather than, I think, what most people do that I know is they'll find a deal and then they reach out to all these people they've had conversations with over the past, and they're shopping and trying to figure out who will give you a better deal. And let's put it this way, you might, like I said, be able to get a quarter point cheaper here or there, but I think the amount of legwork that actually goes through that is just, in my opinion, I'm not sure if the trade-off is there. If not, it's worth it.
Yep. No, that I totally agree with that. Just making a note here. Now that I have more experience, call Ramsey to see if I can get 1 point and into the sevens. I'm just kidding.
Bo, honestly, at this point, I might get you set up with one of those just for all these referrals and recommendations. Definitely.
That's awesome.
Yeah.
So you might have a lot of my listeners just trying to jump out their seats. I'm like, this is the best thing ever. You're getting commercial financing on residential properties, 30-year amortization. The interest rates doesn't even seem that high. What's the catch, right? So for me personally, being fully transparent,
I know where you're going.
Yeah, the only downside, if any, that I personally saw is going to be something called yield maintenance. So can you kind of dive into that a little bit? I don't even know if it's a downside, but if I had to choose something, like a restriction, so to say, would be yield maintenance. So can you talk to our listeners a little bit about that?
Sure. Yeah. So as a commercial lender, we do have prepayment penalties on our mortgages. Main reason for this being is as previously mentioned, we are going to take these loans and put them into securitizations and sell them off as bonds. So we want the bond investor, when they buy the property, to know that they are guaranteed a certain return on their investment. So that is kind of where the term yield maintenance comes from. We are, through this prepayment penalty, we are maintaining the yield of the bond investor. So yield maintenance, simplest way to think about it is you are responsible for the interest owed over the course of the loan. So if you, let's say, have 2 years left on your mortgage, and you go to decide to sell off a property, you would be responsible for those last 2 years of interest on that loan, minus current present value, which is a bit of a caveat, which means we'll be looking at what the current 2-year bond is trading for, because that's the 2-year cost of capital, and subtracting that from your interest rate. So for example, let's say you have a 5% interest rate and your 2-year bond is trading for, right now bonds are incredibly low, but generally, let's say it's around 1 point. So you'd take your 5% minus 1 point on the 2-year bond, and that would be a net of 4. So that'd be 4% interest times by the remaining 2 years. Have a prepayment penalty, that about 8%. Goes without saying, it's relatively costly. So these loans generally are structured so you are generally, I wouldn't advise someone to go into one of these loans if they're not planning on holding the properties long term. So if you really think of it, as long as you're waiting to the last 6 months of all the loans, at least 6 months before maturity, you won't have really any additional payment. So on a 5-year term, that means you'd have 54-month yield maintenance in place. The last 6 months is an open period. That's where people generally will refinance, or maybe if they want to sell off a couple of the properties to kind of let's say, structure. Or on a 10-year term, you'd also have the last 6 months open. Now, there's something I do want to highlight. I mean, we as lenders understand that that doesn't necessarily work for everyone. So we do have some, let's say, more flexible prepayment penalties we can put in place on loans. Now, this does come with a slight increase to your interest rate. So there's a bit of like a sliding scale there, where if you need, you want the lowest interest rate and you're willing to lock the properties up for the term of the loan and not generally, touch them or sell them, then we will be able to give you our most aggressive interest rate. If you're looking for more flexibility, we would be able to add, let's say, anywhere from 10 to 30 basis points to the rate and give you like a 5, 4, 3, 2, 1 step down, which is also a pretty popular structure we have. Should I go into the 5, 4, 3, 2, 1 step down, do you think?
No. I think you hit the nail on the head in terms of what I kind of wanted to share. So the yield maintenance, thank you for explaining that in such detail. For me, the other way to look at it, I did mention it, that it is a potential downside for potential borrowers. However, I also look at it like Ramsey said, if you're locking something in, like if you're purchasing a house and you get financing on it, I think there's like refinance cost if you were to refinance the property, or if you were to sell it, there's like selling commissions. So a lot of people say you want to hold it for at least 5 to 7 years to break even, or you want to make sure that the return, I mean, if you buy a home for $100,000 and it's next to a gold mine and next year it's trading for 200, 300K, then obviously sell it. But in normal circumstances, there needs to be significant upside for you to decide whether to break that term and sell it off, which is basically what Ramsey is saying. So I don't think it's something that's totally unheard of or unreasonable, but it's something that people need to understand going into commercial financing, just because coming from a typical conventional loan, I wasn't aware of the prepayment penalties. But so this is just something that I want to be fully transparent with everybody listening, that they need to understand.
Yeah, well said, though. And I do think it's worth highlighting that if you do need more flexibility, we do have the ability to either shorten the yield maintenance. So for about a 1/4 point increase to the interest rate on a 5-year term, we'd be able to shorten the yield maintenance to 3 years. So that would give you the last 2 years as an open period. On a 10-year term, for 15 basis point increase to the rate, you'd be able to shorten the yield maintenance from 9.5 years, 7 years. So that gives people like that, because they have on the back end more time to try to disposition the properties, and maybe. So I would, like I said, if you need more flexibility, definitely something to look at. And then lastly, on the 5-year term, was really popular is the 5, 4, 3, 2, 1 step down, which means in year 1, you'd be subject to a 5% prepayment penalty, year 2, 4%, year 3, 3%, year 4, 2%, and last year 1%, with the last 6 months being prepayment penalty free. So That one, I would say, probably gives you the most flexibility if you are looking for commercial debt, but don't want to be too restricted. I mean, if let's say you're a couple of years in and decide, something's incredibly lucrative, you need to liquidate a couple of properties. I mean, I don't think anyone wants to pay 4%, but I don't think it necessarily will stop you from moving forward with a pretty lucrative transaction.
Yeah. And this is another reason why I just love working with a private company or a private lender, is that, a lot of these terms are also relationship based, experienced, as well as there's flexibility. It is a sliding scale. Maybe you have to give up some basis points on the interest, but maybe what's important to you is the yield maintenance or the recourse versus non-recourse. And there is that flexibility where Fannie Mae guidelines, there are some bright red lines in the sand. So, it's a pass or a fail, right? So those are definitely some pros of working with a private lender as well. Hey, Ramsey,
100%.
I'm curious, as we're talking, you guys were established in 2012. So even with a 7 to 10 year term, maybe you're just getting some of your earlier clients who are coming up to that termination point. The 5 years, some of them have maybe already matured. What happens at the end? I actually didn't ask this question myself. So let's just say both of my portfolio loans currently are at 10-year terms. If I get to the ninth year, is it pretty easy to just refinance with you guys again? Or what's the process like? Have you been part of that?
100%. Yes. A lot of the 5-year terms from some of our initial loans that we've closed have come due or are coming due in the next few months. So, as a company, for us, that is, we've done everything in our ability to reach out to them and let them know, a few months prior that their maturity date is coming up, and we're going to try to do everything in our ability to win over your business once more. So, if you're already a CoreVest client, you're familiar with the process, and you have, a positive taste, positive experience with us. Obviously, we'll try to do everything in our ability to kind of, get you refinanced and get you fixed, another 5 or 10-year term, and let you be able to continue growing the business through that avenue as well. Pretty good chance also that, in the 10 years your property's ever appreciated, you might be able to do a cash out refinance once more if that is something you are interested in.
Yeah. Awesome. Okay.
And I do want to highlight on that last point.
One
thing about our loan product is it is incredibly flexible. So, generally, if someone kind of explains to me their scenario, I can usually come up with a structure that I think our team would be comfortable with, but I think can also get you comfortable with, whether it be, what the prepayment penalty is. You're saying, hey, in 2022, for whatever reason, I need to liquidate the portfolio. Okay, let's go ahead and structure where that makes sense for you. Or if, non-recourse is very important to me, I need it to be owned in the name of a trust, for example. We can accommodate that request as well. So, there's so many different scenarios that get kind of thrown our direction. I think more times than not, we can, come up with a solution for you. So I do think if you are, in the market and have been told no by other lenders in the past, I think, give me a call. Maybe I can come up with something for you.
Awesome. No, that's awesome. Okay. One last question before I go over to the final question that I have for you is, what's the time frame like from start to finish? Like, this all sounds wonderful. Typically for a conventional loan, maybe it's a 30, 40-day escrow. What can a typical borrower expect from CoreVest?
45 days. About 45 days from when we're into escrow to closing is average. Some get closed quicker. I've closed deals quick as 21 days, about 3 weeks. Some deals for, sponsors that might run into some issues, or, whether it be they're having a tough time, let their tenants not letting them into the property to see something, or, someone came back on title or what have you, sometimes it can go longer as well, but I've done average about 45.
Yeah, no, I didn't believe it at first, I'll be honest, but my first one closed in 30 days. Second one took a little bit longer, I think 35, 36 days. But yeah, both of them were, very quick. And again, I love, the software you guys use. Everything is in the cloud. You just upload documents. They give me the appraisal. I check it on to the next step. It's pretty streamlined, and you guys have it really buttoned down. So yeah, highly recommend it.
Yeah. We use Salesforce, and it kind of is an online portal. So, everything just is downloaded through that. And then every document that we have that we get reporting will be uploaded there. So it's a pretty easy place where all the real documentation is available for both parties. Also, one thing I do always like to highlight, we move as quickly as the borrower. So if a borrower comes and tells us, hey, I need to get this closed in this specific date, and I have, I need the money, the following week or what have you. We could, if you're motivated, get us everything we need in a timely fashion. So we can meet some pretty aggressive timelines if needed. Like I would say anything probably under 3 weeks is not reasonable, but if you come to us and say, 3 weeks and you have all the documentation we need, I think generally we can get that done for you.
Awesome. All right. So we covered a lot on the show, and, looks like, if you're down, I'd love to have you back on for commercial financing 102, right? But I thought this was a great first introduction overview into the commercial financing world. But any parting words of wisdom for potential borrowers looking to get into the commercial financing space as a borrower?
Well, first off, I thank you for having me on, Bo. Definitely, appreciated, being on the show, and I would love to kind of, touch base on some of our other products as well. the line of credit, we can go into more detail. We do have some ground construction financing options, and talk about maybe some multifamily financing as well. So, I mean, we'd like to consider ourselves a bit of a one-stop shop. I mean, with that said, I mean, if you are looking to capitalize, this is going to, all your potential listeners, if you are looking to capitalize on, I think, the opportunities that will be coming, post-COVID. I mean, I'm not going to say me personally, but I think if you read around a little bit, I do think a lot of people are projecting that there will be some, people in some potential, hardships. And with that comes opportunity to pick up some good deals in the marketplace. And I think there's no better way to capitalize on some good deals in the marketplace than having some dry powder, as we call it. So if you're looking to maybe pull some money out of the portfolio, refinance, and have some cash readily available to try to capitalize on what I think people are projecting there be some opportunity, give me a call. I'd love to see if we can get you set up with something. But I think that's all I got. I mean, it was a pleasure chatting with you, Bo.
Yeah, no, this was awesome. And you've spit a lot of wisdom for our listeners today. So I'll have Ramsey's information in the show notes for this episode. Hopefully that was very informative and an educational session for you guys. If you thought that was helpful, please do me a favor and leave me a review on iTunes. We'll see you right back here next week for another exciting episode of the Bigger Cash Flow Podcast. Thank you for listening to the Bigger Cash Flow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.